What if you could wake up every single month to see money already sitting in your account? Not because you worked extra hours or begged your boss. The wealthy don't trade time for money. They make money work for them. You don't need millions or Wall Street experience. Today, we're diving into how 3 specific ETFs can turn a modest investment into a monthly paycheck by 2030. These aren't meme stocks. These are serious income-producing assets, backed by billions and trusted by institutional investors. By the end of this video, you'll know how they work, how much to allocate, and how this strategy can set you free from the 9-to-5 grind. Let's talk about why timing couldn't be better. Something strange is happening in the markets, creating a once-in-a-decade opportunity for income investors. Dividend yields are significantly higher than usual due to market volatility, which fuels income strategies. When markets are uncertain, ETFs that sell options can charge higher premiums, distributing extra cash to shareholders. The more chaotic the market, the more potential income you can make, but this environment won't last forever. Meet JEPI, the JP Morgan Equity Premium Income ETF. It delivers consistent income every month. JEPI boasts $41.27 billion in assets, and it yields about 8.4% annually, meaning $840 a year on a $10,000 investment. JEPI holds around 115 large-cap U.S. stocks, names you know and trust like Microsoft, Amazon, Meta, MasterCard, and NVIDIA. The fund's managers sell call options against those stocks, essentially renting out the right to buy shares at a certain price. If the stock doesn't reach that price, they keep the premium. If it does, they sell for a profit. Over the past 5 years, JEPI has averaged around 11.6% annualized returns, combining strong growth potential with fat monthly payouts. JEPI's monthly payouts are consistent. June, 0.540 cents per share. July, 0.40 cents. August, 0.358. That's why JEPI should make up the backbone of your income portfolio, around 50 to 60% of the total. Now, while JEPI is the powerhouse, you still need a safety net, something that keeps paying even when markets get rocky. That's where SPHD comes in. Officially known as the Invesco S&P 500 High Dividend Low Volatility ETF, this fund is built for one thing: dependable income. SPHD screens the entire S&P 500 to find companies that strike the perfect balance between strong dividends and low volatility. The current yield is around 3.46%. Sure, that's lower than JEPI's, but this ETF plays a different role. Inside SPHD, you'll find companies that are basically dividend royalty. Think Altria, Pfizer, Verizon, Realty Income, and Kraft Heinz. One of SPHD's most underrated features is its automatic rebalancing. Twice a year, it reviews every company it holds. Over the last 5 years, SPHD has returned about 12.08% annually. Over a decade, 8.93% per year. For most investors, SPHD should make up about 25% to 30% of a dividend ETF portfolio. It's here to be dependable, to keep the income flowing. Think of JEPI as the offensive player and SPHD as the reliable defense that keeps your lead safe. Now let's discuss the third piece of the puzzle that boosts your portfolio, the one that turns extra cash into full-on salary replacement. Enter SDIV, the Global X Super Dividend ETF. It yields around 9.64% annually, giving you nearly 10% of your investment back in dividends. This means with a $10,000 investment, you could earn approximately $964 every year, enhancing your income stream. But what makes SDIV truly special isn't just the yield, it's where that yield comes from. Global diversification offers a hidden advantage. Companies are less correlated with U.S. market cycles, providing more resilience for your portfolio. SDIV has paid a dividend every month for 14 years, proving its reliability through economic challenges. It's not perfect. Currency fluctuations and foreign market risks exist, along with a higher expense ratio of 0.58%. SDIV aims to maximize income, and so far in 2025, it's up over 22% year-to-date, while maintaining substantial yields. You've met JEPI, SPHD, and SDIV. Next, find out how to combine them into a plan that could replace your salary. Think of JEPI as the foundation. It should make up about 50 to 60% of your portfolio. With its strong yield, institutional-grade management, and $41 billion in assets, it's the workhorse that's going to do most of the heavy lifting. Next, allocate around 25% to 30% to SPHD. This is your safety net, focusing on reliability and consistency. Finally, put 15% to 20% into SDIV. This is the turbocharger that boosts your overall yield and adds global diversification. Once you've built your portfolio, the next step is where the compounding magic happens. Instead of spending those monthly dividend payments, reinvest them. Imagine starting with $50,000 today and adding $500 a month. By reinvesting, you could generate a life-changing monthly income by 2030. These payments keep coming, whether you're traveling, spending time with family, or just relaxing at home. Every investment carries risk. Dividends can fluctuate, markets can change, and past performance doesn't guarantee future results. It's crucial to do your own research, talk to a financial advisor, ensuring this strategy fits your goals and risk tolerance. These ETFs aren't speculative. JEPI is the largest actively managed ETF. SPHD delivers consistent income for over a decade. SDIV has paid monthly dividends for 14 straight years. These are battle-tested machines backed by major institutions. The window of opportunity won't last forever. Elevated yields, thanks to market volatility, won't be permanent. As volatility fades, yields will shrink. The income streams you can lock in today may not be available in the future. The combination of elevated yields, high-quality ETFs, and consistent monthly payouts is rare. And when those three things align, fortunes are built. Every month you wait is a month you're not collecting income, a month you're not compounding, and a month your future self might wish you had acted. Instead of asking for raises, you'll give yourself one. Instead of worrying about layoffs, you'll build financial security that can't be taken away. Building passive income isn't just about numbers and charts. It's about psychology, about shifting how you think about money. We're taught to trade time for money, but wealthy people flipped that script a long time ago. They stopped asking, "How do I earn more per hour?" and started asking, "How can I make money while I sleep?" They're tools, incredibly powerful tools that take advantage of how the financial system already works. Companies are going to keep making profits. They're going to keep paying dividends. That's why income investing has been one of the most reliable wealth-building strategies for over a century. What does this look like in real life? Let's say you build a portfolio with 60% JEPI, 30% SPHD, and 10% SDIV. On average, that portfolio could yield somewhere around 6.5% to 7% annually, depending on market conditions. That means a $100,000 investment could pay you roughly $6,500 to $7,000 every single year. By the time 2030 rolls around, that income could easily cover major bills or even replace your entire salary. People are quietly collecting monthly checks that rival full-time paychecks without fancy degrees or hedge fund connections. They started now. They didn't wait for the perfect time. The best day to start building passive income was yesterday, and the second best day is today. Every investment carries risk, and dividend ETFs are no exception. Yields can fluctuate, and companies can cut dividends. Spreading your investment across diverse ETFs is key. By building multiple income streams, you ensure stability. Dividend investing is a slow burn, a marathon, not a sprint. While others chase hype stocks, income investors collect checks consistently. Use the market to your advantage and build wealth over time with disciplined, strategic investments. Passive income isn't just about money. It's about options, giving you the freedom to make decisions based on your desires. When your bills are paid by dividends, you get to travel more, work part-time, or start a business without immediate pressure. The earlier you start, the more powerful compounding becomes. Reinvested dividends grow into trees, producing even more seeds. Even small amounts like $100 or $500 a month can snowball into something life-changing over time. Key is consistency. Dividend investing complements other wealth strategies like retirement accounts, rental properties, and businesses, adding a steady income stream. Best of all, it's completely passive. Once set up, the income flows without any additional work. Over the next decade, the global economy is going to change fast. Automation, AI, and new technologies will reshape industries. But one thing that won't change is the value of reliable cash flow. People will still need housing, electricity, food, and technology. Companies will still pay dividends. Investors who position themselves now will collect income long after the headlines change. So where do you go from here? Start small, open a brokerage account, research ETFs, and build your income portfolio. Even if you invest a few $100s, you're setting something powerful in motion. A machine that works for you 24/7. You know the blueprint. You understand how JEPI, SPHD, and SDIV are powerful tools for generating monthly income. It's time to put the plan into action. Every month you wait is a month of income you'll never get back. Most people will just watch and nod. A small group, maybe you, will take action and build their portfolios. They'll reinvest dividends and let compounding work its magic. A few years from now, money will be working for them. If you're serious about financial freedom, the best time to start was yesterday. The second best time is now. If you made it this far, you mean business about your financial future. Hit subscribe for more insights. Like this video if you learned something valuable, and comment on which ETFs excite you for your portfolio.